Dear ladies and gentlemen, good morning everyone, and welcome to the second webinar for Auga Group. Today Nasdaq Vilnius is hosted by CEO of the company Linas Bulzgys and CFO of the company Martynas Repečka. Before we proceed with the presentation, I will shortly remind you the agenda. Firstly, Mr. Bulzgys will comment Auga Group unaudited financial results of 2018 and inform about current events in the company. Right after the presentation, we will open the floor for the questions. I invite you to use the question box on the right side of the screen. All questions will be addressed after the presentation. Mr. Bulzgys, I invite you to start the presentation.
Million euros revenue in 2018, which is 12% increase versus 2017. However, key profitability indicators were significantly below 2017 level. Company incurred 6.3 million euros loss versus 5 million euro profit last year. And our EBITDA was 3.3 million euros when last year 14.2 million mark was reached. As covered in our previous webinar and the Q3 reporting, the major downside came from agriculture. And now we go into more specifics segment by segment. So first and most important segment is crop segment. The last season was really challenging for agriculture in whole Europe and in Lithuania as well. So heavy rain in autumn 2017 was followed by drought in summer 2018. In our case, due to recent two company acquisitions, our cropland increased by almost 50% from 27,000 hectares. Our cash crop, increased significantly and it became 27,000 hectares, comparing to 18,000 hectares in 2017. And rainy 2017 autumn did not allow to perform proper winter seeding, which resulted in significantly large areas which we needed to seed with summer crops in 2018. So we ended up with 80% of summer crops in 2018, comparing to 56 in 2017. And due to specifics of organic farming, about half of summer crops areas was seeded with the legumes, which is peas and beans, which in normal year is very profitable crop. And drought in summer 2018 negatively affected almost all crop yields. However, legumes were affected particularly negatively by drought, and this had a significant negative effect on Auga Group bottom line. Also, there was mixed changes in other cash crops yields in 2017. For instance, yields of sugar beet, soya, corn were higher, while rapeseed, oat, rye, and other smaller crops were lower. Let's look at historical data on the major crop yield, which is wheat and legumes. You have here numbers for internal Auga numbers and Lithuanian data. So in 2017, Auga on wheat reached 4.1 tons per hectare yield. In comparison, conventional wheat yield in Lithuania was 4.9 tons per hectare. This year, organic wheat yield, which Auga managed to reach, was 2.8 tons per hectare, and conventional yield in Lithuania dropped to 3.7. On legumes, in 2017, Auga achieved 3.3 tons per hectare, which was even higher than conventional farming yields achieved in Lithuania. So this year, Auga legumes yield fell to 1.4 tons per hectare, and conventional farming dropped to 2 tons per hectare. These are major yield information. Now, the key elements defining result of agriculture segment is fair value and of individual crops. So in other words, it's prevailing market prices at which crops will be sold, and direct cost incurred on each crop. So the average prices for wheat and legume in season 2017 and 2018 were almost in line with prior season. We have some bigger decrease on other cash crops, but however, other cash crops numbers are a bit distorted with the mix where we have sugar beets, which have high yield numbers in terms of tons per hectare, but lower prices. Well, generally, what this slide indicates is that organic crop pricing is very stable, and that company manages to sell this at these prices, the crop commodities in international organic markets. In addition, we should draw to your attention that because of acquisition of Raseiniai Agra, about 23% of our harvest was still in the transition period, and respective harvest was evaluated at so-called P2 prices, which normally is lower by 10-30% comparing to fully organic product prices. And next year, for all our harvest will be fully organic. Let's go now to cost side, and this can be seen from this data. The cost per 1 hectare of cultivated land after eliminating some one-off costs remained very similar level comparing to last year, or even improved for some crops. And this is achieved despite the significant increase in cultivated land, very complicated autumn in 2017 due to rainy weather, and also very challenging 2018 spring, where we had to seed double area and in also very complicated conditions. All the factors which normally likely to hit on your operational cost. So we managed to achieve this thanks to our constant organic agricultural process improvement, supported by investment into necessary technology and innovation. And bottom table basically presents gain-loss numbers for each crop, which is just a function of previous parameters: yields, price, and cost. So as it can be seen, the biggest hit comes from legumes. All in all, negative agriculture performance was caused only by yield drop of most important cash crops due to weather conditions, and prices and cost remains stable. The next element we added into this webinar is also cost of forage crops. Forage crops also is important element for agriculture and for dairy segment. Just to remind you that in organic farming, proper crop rotation is very important element, which ensures long-term sustainability of organic farming. Efficient crop rotation means that about 20-25% of our land is constantly seeded with perennial grasses, which in our case form also the feed base for our dairy segment. So the fair value of forage crops at its point of harvest is normally measured at production cost, since there is no active market for forage crops. So as a result, net result of revaluation of forage crops at point of harvest is always equals to zero. In other words, we do not recognize any profit on forage crops. So after elimination of one-off costs, average cost of forage crops last year was higher than previous year, and this comes mainly because we needed to, according to our schedule, to plant additional new grasslands last season. However, drought in 2018 also negatively affected forage crop yields. Average forage crops yields was 4.9 ton per hectare last season, when the season 2016-17 6.1 tons yield was achieved. And talking about a bit more about next season for crops segment. So last autumn was really very favorable for land cultivation and winter crop seeding. Company managed to seed almost 53% of land dedicated to cash crops with winter crops, mainly wheat. Last season, this number was only 20%. In 2016-17 season, it was 44%. Normally, potential for winter crop is higher than for summer crops. For instance, last season, winter wheat generated 27% higher yield than summer wheat. So far, so what we see, winter survival of the crops is very good. We had rather mild winter with decent snow cover during most of the winter. And good weather last autumn also allowed to prepare with high quality areas for summer crop seeding, which is very important in organic farming, as successful weed management requires sufficient quality work done in both autumn and spring. In other words, we are much better prepared now for good quality summer crop seeding in this year, and also we will be able to work more cost efficiently due to better workload balance between winter and summer seeding and further improvement in our technologies. At the beginning, at the beginning of this year, we also signed a 3-year agreement with Nordic Sugar Kėdainiai AB for growing and selling organic sugar beets. And as a result of this, we are going to double our sugar beet growing areas from 800 hectares last year to 1,500 hectares planned for this year. And sugar beets were one of the most profitable crops in 2017-2018. So time runs really fast, and today we already have first day of spring, which means we are only 5 months till the start of new harvesting. So we are very well prepared for this season, and we have big confidence in our ability to deliver results. So now I will hand over to Martynas to cover some other segments.
Good morning. My name is Martynas, and I will cover 3 additional business segments of Auga Group. And the first one is mushroom growing segment that I would like to cover. And as it can be seen from the slide, the revenue of the mushroom growing segment was 26.5 million during 2018, and that is around 2 million or 8% higher compared to 2017. And the revenue from mushroom sales increased actually by 2.3 million, while there was a slight decrease in mushroom seedbed sales. And mushroom sales revenue increase relates to both increased sales volume and the average sales price. And sales volume increased by around 1%, while average sales price increased by almost 10%. And the average price increase relates to 2 reasons. The first reason is that the average price of non-organic mushrooms increased. As it can be seen from this graph. And the other reason is that the share of organic mushrooms sold also increased steadily during 2018. And measuring in revenue, in total revenue of mushroom sales, organic mushroom sales accounted 6.6% in 2017 and 10.8% in 2018. The total cost of sales of mushroom growing segment was 24.7 million in 2018, or 1.2 million higher than in 2017. And the average cost of 1 ton of mushroom sold increased by 6.4%. And although mushroom growing segment faces challenges from increasing labor, fuel and other costs, it managed to increase average sales price more. And the same tendency should be seen in the near future as well, since additional price increases are already accepted by the clients. So that brings us really optimistic about the mushroom growing segment. And significant revenue increase resulting in a higher gross profit of mushroom growing segment, which totaled 1.7 million in 2018, compared to 0.9 million during 12 months of 2017. And now I would like to switch to dairy segment. And dairy segment sales revenue for during 12 months of 2018 amounted almost 9 million and was around the same level as in 2017. And total amount of milk sold slightly decreased from 23.1 thousand tons in 2017 to 22.6 thousand tons in 2018. But and the average milk price was around 359 euros per ton and was around 1% higher compared to the same period in 2017. And the share of organic milk sales volume increased to almost 46% in 2018, comparing to only 14% in the same period of 2017. However, lower market prices of non-organic milk led to average sales price of milk sold at almost similar level as in 2017. And the share of organic milk sales by volume fluctuated during the first half of the year around 30 to 40%, as it can be seen from this graph. But the share of organic milk sold at organic prices increased in September, and the average share of milk sold at organic prices was 74% in the fourth quarter of 2018. But of course, as it can be seen from the graph, the fluctuations in the share of milk sold at organic prices remains significant, because the sales are still dependent on several most important clients and their business needs a particular month. But we are working forward to increasing client list and to make sure that these fluctuations becomes not so significant. And the share of milk sold at organic prices gives important effect on average milk price sold, because organic price premium is around 30%. And talking about the dairy segment cost of sales, it increased by 22% and totaled to 10.3 million during 12 months of 2018. And the deterioration of dairy segment cost of sales is mainly driven by increased cost of feed. And cost of feed increased by two main reasons. The first one is that due to unfavorable weather conditions in 2016-2017 season, and as well in 2017 and 18 season, the grass feed preparation was complicated and the yields were comparably low. And the other reason is that organic grains used for cattle feed during 2018 were harvested in 2017 and were evaluated at high organic prices. And the rise of cost of feed resulted both in higher milk production cost and cattle growing cost. And the gross loss of dairy segment was 2.4 million for 12 months of 2008. Gross loss, was 2.4 million for 12 months of 2018, compared to 0.6 million gross profit in the same period of 2017. And the last segment I would like to cover today is end consumer packaged goods. And this segment, as in previous periods, demonstrated steady revenue increase. And total revenues of end consumer packaged goods segment amounted to 1.9 million in 2018, and was 1.8 times higher compared to 2017. And steady increase in and consumer packaged goods segment demonstrates good potential for this segment development in the future. As it was mentioned earlier, segment is of strategic importance for the group due to the diversification of existing business lines, as well as adding more value to existing products. And this segment covers ready-to-eat soups, preserved mushrooms, packaged vegetables, bottled milk and milkshakes, and other products. And you can see in this graph the structure of revenue of this segment. And 43% of segment revenue comes from preserved mushrooms, vegetables, and ready-to-eat soups. Packaged vegetables coming second with 22%. And it is important to note that distribution of consumer products with Auga brand in domestic Baltic markets was increased significantly during last 6 months. And this gives really a solid base for future sales development in the Baltics in 2019. And in addition, further progress was achieved in export markets as well. And contracts are finalized and sales are expected to start soon to such markets as United States of America, South Korea, United Arab Emirates, Romania, Ukraine. And so that shows the future potential of end consumer growing end consumer product segment. Most of products during 2000 of end consumer packaged goods segment were sold on comparably low scale still, and that resulted in comparably a high cost of sales and low margins at the moment. And cost of sales amounted to 1.8 million in 2018 compared to 1 million in 2017. And the segment earned 70,000 euros gross profit in 2018 compared to 50,000 in 2017. And finally, I would like to comment on operational expenditures a little bit. And the level of operational expenditures during 2018 was highly impacted by two so-called one-off effects, or more precisely, the cost related to termination of Arginta Engineering purchase agreement and reversal of impairment of Karakash Agro and Karakash company's property, plant and equipment, which had an opposite effect actually on the operational expenditures, or in other words, positive. And for better comparison, we have eliminated these one-off effects in the slide provided. And group operating expenses during 2018 amounted almost to 10 million and was around 60% higher than in 2017. However, I would like to comment several major increases in these operational expenditures. And of payroll and social security expenditures increased by 200,000 euros, of course, by increased average salaries and number of personnel. The other more specific effect was that depreciation or amortization cost included in operational expenditures increased by 360,000 euros in 2018 compared to 2017, and this was mainly due to amortization costs of long-term land rent contracts and tangible assets, which was accounted after acquisition of Auga. And one more point I would like to cover is that 200,000 euros of accounts receivable impairment was accounted in 2018 in application of new International Financial Accounting Standard 9 financial instruments, and according to these standard requirements.
And the last but not least important section of our presentation is about capital expenditures and capital projects. So in 2018, our total CAPEX reached 11 million euros. About 8 million was spent on construction and machinery, of which large part is related to investment into two new acquired farms in 2017-2018, which increased our cultivated land from 25,000 hectares to 38,000 hectares. These two companies needed additional specialized tooling, also building up of their working capital in 2018. About 1.4 million was spent on acquisition of rented agricultural land. In 2019, our capital investment plans are restricted because of our weaker performance in 2018. We have agreements reached with our creditors, crediting banks, that we will cap our capital expenditure to 2 million euros till end of third quarter, when the results of this year crop season will become evident. So I will go with some more details what we're going to do with this 2 million euros. So the most important strategic project for us is organic combined feedstock plant, into which we are going to invest 0.9 million euros. And this will be done in Auga Grūduvai in Šakiai region. We will make significant upgrade of existing facility, and this project started in January and will be ended in June. So after implementation of these projects, we will be able to produce 50,000 tons of high quality combined feed, and this projected output will fully cover Auga's internal needs for dairy cows and chicken, and also will allow us to start external sales into EU and US markets. We are now working a lot commercially on this initiative, and US, for instance, US market imports a lot of organic feed because they have problem with GMO contamination, and but the market is of meat and poultry is growing rapidly, so we really see lots of opportunities there and in Europe as well. And this also has strategic importance because we want to diversify away from simply selling organic commodities. Today they really have a very stable pricing, but still commodities have always own risks related to supply demand. So we want to entrench ourselves into a bit different value chain with our major products. So about 200,000 euros will be spent on animal welfare projects, which should help us to improve also dairy cows utilization rates and productivity. About 600,000 euros we are spending on machinery and equipment for crop growing segment. And a big part of this also relates to sugar beet area increase, for which we need additional investments. About 200,000 euros spendings will be then related to biogas conversion and purification projects, and about 100,000 euros related to some other minor projects. So we hope that we will be able to get on track of implementation of our development projects in 2020. So this is more or less additional information which we wanted to give you, and now we are ready to answer your questions.
Mr. Bulzgys and Mr. Repečka, thank you very much for your presentation. And now, indeed, we are awaiting your questions. And please write them in the written form and use the question box on the right side of the screen. We're still waiting your questions, and as I remember, during the third quarter webinar presentation, there were a lot of questions related to the covenants and the banks. So could you comment a little bit regarding covenants fulfillment?
Yes. I will answer your question. And yes, indeed, due to significant deterioration of group's financial results in the second half of 2018, we had negotiations with our main creditors or banks about covenants. And credit and credit line agreements with main lenders of the group were amended at the end of 2018, and it was agreed not to apply financial debt and EBITDA debt to EBITDA ratio covenant until the end of third quarter of 2019. That is until the results of a 2018-2019 season harvest. And credit lines were also prolonged to one additional year until the end of 2009, almost the end of 2019. And since the financial debt to EBITDA ratio covenant was not applied at the end of 2018, Group managed to meet or met all financial covenants set by creditors as at 31st December 2018. So, the situation with the banks is solved, and covenants are met at the end of the year.
Okay, and we are still waiting for your questions. And since there were some changes in the half part of previous year in the ownership structure, so maybe you could comment a little bit what about of the corporate governance area?
Since completion of our SPO, we had commitment to perform an agreement actually with EBRD to perform additional corporate governance due diligence. So we've done this in the last quarter together with Baltic Corporate Governance Institute, members of which we became. And as a result, detailed analysis was done, and certain conclusions were drawn, and we plan to make some changes in our corporate governance structure very soon. And together with this structure, there will be also new members in our corporate governance bodies, which will represent new shareholders which joined the company in previous SPO. And all these changes will be announced soon, and will be provided for voting in the nearest shareholder meeting.
Thank you very much for your comment. And now we received one question. How much in percentage increased the loan margins after breaking the net debt covenant?
Yes, I will answer your question. And first of all, I would like to point out that, as I have mentioned, Auga Group did not broke covenant net debt EBITDA covenant at the end of 2018, because it was agreed not to apply this covenant at the end of the year. But yes, margins of long-term and short-term loans was increased, and it was around 20 to 30%, depending on actual loan.
It seems that there are no more questions. A record of the presentation will be available in the Nasdaq Baltic YouTube channel, webinar playlist, and the company's website, auga.lt. Mr. Bulzgys and Mr. Repečka, thank you very much for your presentation and answers given. Participants, thank you for your joining, and have a good day.